This video is going to cover all the basics regarding retirement planning and life insurance. Now, retirement planning and life insurance could mean different things for different situations. The first type of situation would be growth and income planning, meaning that somebody's trying to leverage a properly structured cash value plan, such as an index universal life plan, to make sure that they're hoarding dollars within their cash value, they're stripping away their costs, known as stripping away their net amount of risk, to try to grow their accounts or try to grow their cash value as high as possible so that when it comes time that they want to retire, their ideal retirement age, they could take that through a successful route, meaning take it through tax-free loans, take it through tax-free withdrawals. So there's a whole multitude of different ways on how to do that. So that's one side of the coin. The other side of the coin is for the individual that's focused primarily on death benefit, that they hit their retirement stage or they're nearing their retirement stage, and they're saying, okay, I was working for a company. I know that I had life insurance coverage through that company, but if I retire, I'm no longer working for that employer, well, then I'm going to lose my coverage. What do I do? So, what are there some effective routes to make sure that you could go and try to set yourself up on a personal plan? Maybe try to do some sort of conversion based on what the opportunities are that the employer is allowing to say, okay, if you're no longer working here, maybe you could have some sort of retirement life insurance that they'll be, offering you. Or what are some different mixing and matching that you could do to make sure that's going to cost you the least amount of money, but give you the highest quality, largest death benefit that's appropriate to your goals. The other aspect is also pension maximization. So this could be for an individual that, let's say they're going to receive X amount of dollars because they're going to be receiving pension income for a single life. But then if they receive joint life income, it's going to have a substantially reduced monthly income amount. So there's different techniques on those pension maximization strategies that an individual could go take the single life option, take out a life insurance policy, a permanent life insurance policy on themselves. And if that permanent life insurance policy is cheaper than what the reduction of the single life to joint life would be, it makes mathematical sense to do so. So if that sounds confusing, just kind of bear with me on it. I'm going to show you different examples. And the last aspect is really just legacy planning as a whole. Is it important to you to leave some sort of legacy, to leave some sort of death benefit by the time that you pass away? Or are you fine with just trying to burn through the cash and trying to use up as much of your cash as possible because your loved ones may be completely fine if you were no longer there and they didn't need that extra that extra cash flow, that extra income upon your passing? So really just depends upon your situation. Each situation is different. But for the individuals that do have importance of a death benefit, then what some really neat strategies you could do, or individuals that are just trying to grow their accounts and just leverage the tax benefits of cash value products. How can they leverage these sorts of strategies successfully? So to make sure that we're going in a linear sequence, first for the individual that's younger, that wants to grow their monies, grow their cash value, and then eventually take income from it. What do I mean by that? And you're going to see this little bullet point as cash value products. So you have permanent life insurance policies are different than term life. Term life insurance is basically saying that you have death benefit coverage for a term amount of time. So that could be 20-year, 30-year, 15-year, 10-year, whatever that case is. So that says, let's say somebody has a 10-year term policy for $1 million and they passed away 15 years into the future, well, they have no more life insurance coverage. If they passed away, let's say 5 years into the future, well, then $1 million would get paid to beneficiaries. So term serves its purpose. You could segment each little plan, each little life insurance policy based on what you're trying to accomplish. So like if let's say somebody has 20 years left on their mortgage, it might and they want to make sure that their loved ones are covered in case they pass away, that the loved ones don't get kicked out of the house, so that basically the house could get paid off. Then they might want to set up a 20-year term to make sure that it's going to correlate to how long that mortgage is going to be there. So that, God forbid, the breadwinner passes away, the life insurance policy would pay for the mortgage, and therefore that person has their house paid for so that their kids, their spouse, whatever that is, could stay into that home. So that's one aspect. The opposite side of that is permanent life insurance. Permanent life insurance has something known as cash value, which is an equity building component within those plans. It sounds great. In reality, it could be a complete disaster if you structure it the wrong way. There's certain aspects to cash value that give an individual tax-free benefits, meaning tax-free growth, could take monies out, tax-free income, and then also whenever that individual passes away, they are leaving a tax-free death benefit. So whenever I'm talking about growth and income strategies for properly structured cash value plans, what exactly do I mean by that? Well, every life insurance policy has some sort of risk. There's either a risk to an individual or as risk to the insurance company. When the risk is largest to the insurance company, they're going to charge a higher price. When the risk is lower to the insurance company, they're going to charge a lower price. So there's ways on how an individual could go and figure out how much money that they want to place into one of these types of strategies, but make sure that their death benefit is as low as legal limits allow. What I mean by that is all those nice tax-free benefits of cash value have to make sure that they're staying within something known as modified endowment contract, MEC limits. So you want to set up something known as a non-MEC plan, meaning that there has to be a minimal death benefit based on how much cash value is going to accrue. As cash value is increasing, death benefit should be increasing. As cash value is going down, death benefit should be going down. So you have something known as a cash value corridor. The way on how these plans are created is making sure that whatever dollar that you want to set up, and for however long, however many years that you want to set that up, that you're triggering something known as the minimum death benefit max cash value within that specific plan. So that's saying that you're not so fixated on how high the death benefit is, because if you have a really high death benefit policy, that's going to result in a higher cost, and therefore more costs are going to mean less dollars sitting in the cash value. Ultimately, if we think of cash value like a bucket or like a funnel, you have premium dollars that are going into a plan. Those premium dollars are going to be eaten up by different costs of insurance and other expenses known as the net amount at risk to the insurance company. So if you're reducing the amount of expenses, that means that more dollars are going to net into that cash value bucket. On top of it, it doesn't only grow by the net contributions that you're placing into the plan, but it's also growing by the rate of return that's coming back. So if somebody's trying to set up a whole life insurance policy, you have this rate of return is going to be fixed. It's going to be known as a dividend rate that's going to be getting paid. So regardless of whatever's happening in the market, that dividend rate should be pretty consistent. Now, it could be high, it could be low. It really just depends upon the carrier. The other aspect to a permanent life insurance policy would be something known as universal life, which this was very attractive in the 1980s because you had interest rates are at all-time highs. So interest rates were paying double-digit figures where an individual was saying, okay, if I'm placing these dollars, if I'm reducing the amount of net amount at risk and able to hoard as many dollars into my cash value of the net premiums, well, then this rate of return is going to be high. Unfortunately, interest rates have gone by the wayside since the 1980s. So now what they were expecting to receive, 16, 17% rates of return are now only paying 2% rates of return. So those policies are known as blowing up. And this is why universal life has had really bad reputation in previous years. Another aspect is leveraging mutual funds, or they're known as sub-accounts, is through variable universal life. And that means that the interest rate is going to be based on how well those mutual funds or their sub-accounts perform. So if those mutual funds perform positive, then there's going to be added positives into the bucket. If the mutual funds come back negative, well, then you're going to have a negative to the bucket and is essentially slicing the bucket. The problem with variable universal life is you have expensive sub-accounts, and then if there's a downward market hiccups that occur, especially right before you're going to retire, it could have large detriments to your cash value. So that's something to be mindful of. So really the safest routes are going to be the whole life insurance routes, and then also the indexing universal or index universal life insurance. The way an index universal life insurance works is you're going to either receive a credit based on how well those indexes perform, or you're going to receive 0%, a credit or 0%. So historically, when you're looking at really good indexes or IUL plans versus whole life insurance plans, indexes can produce a higher rate of return. So as long as they're properly structured, you could have a much more favorable route leveraging an IUL than a whole life. Now, that doesn't mean that individuals should not go into whole life. That just means that if they're trying to leverage a cash value maximization plan, it depends on their situation. If individuals are more risk averse and they say, I just want to have this fixed rate of return, I understand the concept of an IUL, but I like the fixed, then they go with whole life. If they don't like the concept of fixed because they feel like the rates are too low and they want to have a higher growth projection, then they might want to go with an index universal life. So those are really the two main ones that we see, especially when someone's trying to leverage them as a type of retirement play. Somebody that has, 10, 15, 20, 30 years out, and they say, I want to make sure that I'm receiving tax-free income in retirement. How exactly can I do this effectively? That's where they could set up a properly structured IUL or properly structured whole life insurance plan. So I hope that brings some clarity to the growth and income related situation for individuals trying to leverage life insurance for retirement planning. Now, there's a lot of problems with when individuals try to do that, and it has to deal with high costs, low cap rates, and also income restrictions when somebody's trying to pull out money. So conceptually, it sounds great. In reality, it could be a complete disaster if you don't know what you're doing, or if you're leveraging an advisor that's just trying to increase the amount of death benefit, increase the amount of costs to give themselves a hefty commission. That obviously a larger commission, larger fees will mean less dollars growing within that cash value plan and ultimately having you waste years and thousands of dollars in the wrong direction. So that's why you want to be careful with when you're leveraging that growth and income strategy. If you have specific questions regarding properly structured cash value plans, you want to speak with an advisor, feel free to give our 1-800 number up on the screen, 1-800-566-1002. Now, the other side of the coin is more for individuals that want to fixate on the death benefit. And they're saying, okay, I'm nearing retirement. I understand that the only sort of death benefit plan that I have, only sort of life insurance plan that I have is through my job. If I no longer work there, well, then my company is going to be taking away the life insurance. What do I do? And this is where an individual, if they're healthy enough and they are insurable, they can get set up on an individual plan. Now, be mindful, that might not be necessary. If you do not have any aspirations to leave a death benefit, or it's really not that important to you, it's going to cost you so much more money and not allow you to properly retire, well, then it might not make sense to try to look towards the individual coverage. Because be mindful, you're not, if somebody's nearing retirement, let's say they're retiring at age 65, it's not like they're trying to purchase a life insurance policy when they're 30 years old. When they're 30 years old, there's a lot less risk to the insurance company to insure a 30-year-old than it is for somebody that's much closer to death at a 65-year-old or a 70-year-old or an 80-year-old. So this is where you really want to look at, okay, underneath the hood, which ones have the nice sweet spots based on what your sex is, male, female, what your age is, what state you're in, what sort of features and benefits that you're trying to mix and mold with that death benefit plan. Because you could also have ancillary benefits where you could have a long-term care riders that are built into these plans for no additional cost that says if you come into a long-term care scenario that you could leverage portions of the death benefit as a living benefit to pay for that long-term care. So there's a lot of really neat features you could do on individual policies, but the downside of where we've seen complete disasters with this is somebody's going to be retiring and they do not go with some sort of permanent policy that their employer may be offering. And they just say, oh, I could easily get my own permanent plan. And all of a sudden they go and they try to get insurable. They try to get coverage. And the insurance companies are saying, no, you have this ailment. You have diabetes. You had a stroke. You had cancer. You had all this other, crap. You're morbidly obese, whatever, or you're a chain smoker, whatever that case is. All of those different things, the insurance company, they're not going to be biased, but they're going to also look at it from a risk perspective. If somebody's on their deathbed or they had, 3 heart attacks in the last 2 years, they're not going to say, yes, we want to go and insure this guy. Or if they are going to insure this guy, they're going to make that guy pay a shit ton of money to get that sort of plan. So that's the ways you just have to look at it from a risk return standpoint. If you could potentially be losing coverage, well, then this is something to obviously look at the drawing board and say, okay, if I was to go with my employer plan and they'd give me some sort of permanent life insurance coverage, how much does that cost on a monthly basis? How much would it cost if I could get a standard rating or a preferred rating or even a substandard rating? Would that be cheaper than going through the plan through my work? Many times we notice that individual plans are cheaper than going through the work plans, especially if the person is older. If you're at this crossroads and you don't really know what to do or really how to look at it properly, feel free to reach out to us. And we have an entire case design team that leverages all the different carriers in that individual's area to make sure, okay, it'll make more sense to go with company XYZ, because you could get this on either a permanent basis or a term basis, whatever that is. That'll be more appropriate for what your needs are, and it'll be cheaper with a higher quality. To make sure that you could get, to that retirement planning success. So that covers the losing coverage aspect. Legacy planning, this could be dissected in a few different ways. You could have it set up with estate planning if you just want to make sure that, God forbid, you were to pass away, that your beneficiaries would receive some sort of lump sum benefit. You could receive a tax-free lump sum benefit. That's where individuals are leveraging life insurance to do so. They use life insurance because it's using the law of large numbers. They're paying premium dollars on a monthly basis, on an annual basis to say that I want to have this lump sum dollar amount go to my beneficiaries so that it's as if I'm still living, I'm still working, I'm still making money for me and my family, and I'm able to leave that sort of legacy, to my loved ones, in case I pass away, whether that be premature death or just whenever the date is that person passes away. So that's where the legacy planning aspect. So there's a whole multitude of customization ways to do that. Whenever you're looking at it, just always say, okay, well, what's going to cost me the least amount of money that will get me the most amount of benefit or get me the correct benefit. Whether that is that you know what that benefit is, you say, I need exactly $500,000, of a life insurance policy, or you say, I actually don't know what to do. I don't know what my number is. That's where we'll sit down with you and we'll help you figure out what that, what that specific formula is, what that specific death benefit is. Or it could just be that what you're doing right now is perfect, and you might have more than enough assets that are going to be left over as a legacy play, where you don't even have to use the life insurance as part of your retirement planning process. The third bullet point is pension maximization. And this is something that it's so simple to understand it when you're looking at it from the 30,000-foot view, but a lot of people do not take the time to realize their leveraging opportunities. So what I mean by that is, with a pension plan, we know a pension plan is a lifetime income stream that someone's going to be receiving from their employer when they hit X amount of years of service. So as an example, if let's say you have somebody that's working for a company and they started when they were 30 years old, and the company says, we have a pension plan for you. When you hit age 65, that's going to give you 35 years of service. We're going to pay you, if let's say it's a male and they retire at age 65, if they want to take the single life payout, it's going to give them $100,000 per year. I'm just going to use a really simple hypothetical example. Or if they want to cover them or their spouse, they're going to be able to take the joint payout option, but instead of receiving $100,000 per year for the single, they're going to give them $60,000 per year for joint. So the difference between that is saying whenever the single individual passes away, that income's going to stop. Nothing gets left over to beneficiaries. Whenever the joint lifetime, if they're leveraging joint lifetime income, if let's say they're, both, the individual and their spouse are living, the individual passes away, the joint recipient could still be receiving that income. Whenever he or she passes away, well, then the income will stop. Nothing will get left over to beneficiaries. So a way in how somebody can leverage life insurance for a pension maximization strategy is maybe for $20,000 of a premium, it's going to cost $20,000 for, let's say, $1 million of life insurance. An individual could take out the single life income option, receive $100,000, know that out of that $100,000, 20 of it's going to have to go to a $1 million policy, and that would allow them and their spouse to still net $20,000 more because $100,000 minus the $20,000 premium, if all things being equal. Now, obviously, there's some other tweaks with this, and there's other results when we deal with taxation and all of that. But just for simplistic purposes, this individual and their spouse would be able to net $80,000. So let's just say that you have a male and female. The male is the one that has the single life pension option. He's living. Both him and his wife are able to receive $80,000 of net benefit, $80,000 of net benefit, because technically they're receiving $100,000, but $20,000 is going to the life insurance play of $1 million that's on that individual's life. Let's say that the spouse, that his wife passes away before him. Well, if that happens, there might not be a need for that life insurance policy anymore, so therefore he could stop paying premiums and he could just exhaust that life insurance. So therefore his $80,000 net benefit will increase to a $100,000 net benefit upon the passing of the wife. Let's say if the wife doesn't pass away, but the husband passes away, and that's where all the pension money was detailed towards, was that single life individual. They were collecting $80,000. All of a sudden he passes away. They're not receiving $80,000 anymore, but that's where the life insurance would kick in and would pay that spouse $1 million of tax-free death benefit. So now the spouse could leverage that sort of component as their own retirement play, and now they have a bucket of $1 million to allow them to not outlive those dollars and making sure that they're creating an income-related strategy for it. So that's what I mean by pension maximization strategy. You could use these individual tools. Think of life insurance like a tool, just like if you're leveraging an IRA account that's set up for growth and you want to be super aggressive with those monies. That's a tool. That's a tool with investments. Or if you're leveraging a fixed account, that's a tool with a fixed account with fixed rates of return. So everything is segmented like individual tools in a tool belt. It's just from a retirement planning perspective, how can it be most easily used? How can it alleviate the most amount of stress? So you're placing the smallest amount of dollars into it and getting the most amount of benefit that will correlate to your goals and correlate to the chances of your success. So I hope that these strategies make sense. Once again, it might pertain to your situation, it may not. If it does, if you want to find out further information, feel free to reach out to us. The problems with these, as an example, cash value plans. If you're trying to set up a properly structured cash value plan, but you have very high cost of insurance, very high net amount at risk, Well, then that just means that each extra dollar is going to be going to that cost of insurance. It's going to be taking away from the cash value accumulation, which is the whole purpose of what you were trying to use that plan to do, to grow tax-free, be able to pull those monies out tax-free at the highest possible rates. And this is where it determines, it's based on the type of carrier that you're using, based on the type of product that you're using, based upon the type of indexing strategies that you're using as well. If you're in a cruddy index with a low cap, that could give you a lot less benefits than something that will have an uncapped indexing strategy with a favorable index, a favorable uncapped index that allows you to receive gains when the market goes up or gain 0% whenever the market goes down. So that's different things to consider. So the problems that I see with these are individuals just going with an insurance company that they know, that they saw a commercial on, and not necessarily the correct one for their age, the correct one for their time horizon, for how long they need that accrual to take place. And then most importantly, income restrictions. When it comes time to start pulling these dollars out, there's different things known as loan provisions. You could have a loan provision set up in index loan options. You could have it set up in variable loan options. You could have it set up in fixed loan options. You have some carriers that only give you access to a fixed loan option. That's a huge detriment compared to another carrier that could give you all three of those options or two of those options that are not just handcuffing you to saying, okay, you could only take a fixed loan option, because what a fixed loan means is that you would receive less money than what you're capable of arbitraging your dollars with an index loan or a variable loan. So it's all these little slight tweaks that make such a large mathematical difference. Another common mistake we see is when someone's trying to leverage a pension maximization strategy and the life insurance is significantly more expensive than what the net benefit is, the net difference between the single life option and the joint life option. So like, as an example, let's say if we have, a husband that is being offered $100,000 for a single life pension option, or for a joint pension option, they're going to be getting $95,000 per year. Why would they not go with the joint life option if that's what's most important to them? It's a $5,000 difference. $5,000 isn't going to be able to compute to $1 million or $2 million of a death benefit. So therefore, they could be shooting themselves in the foot by trying to use this type of, single life pension maximization option because some advisor that's more, money hungry that wants to sell them a life insurance policy, is going to tell them 10 different ways on why that's necessary. Each situation is different. Once again, it could make sense, or sometimes these pensions, they pay out a boatload of money, and it makes sense to leverage the employer pension as opposed to leveraging some sort of pension maximization strategy or leveraging some sort of single life option with the life insurance supplement. So you just want to be very careful with that. The other aspect is also insurability. Individuals should not just get rid of their life insurance through their employer unless they know that they are insurable. At least maybe they want to go through the application process with the life insurance policy, know that they're going to be given some sort of offer of a standard plus, preferred, non-tobacco rating, whatever that case is, to say, okay, I can cancel my work plan because I know that I'm going to be able to get coverage on an individual plan basis. And the reason why I'd be doing the individual plan basis is because it's going to net in much more dollars to me, much cheaper cost than leveraging the inferior employer plan. So that's the way you also have to look at it. So the problems are when somebody is deemed uninsurable and they try to just, get rid of their coverage, then they're shit out of luck at that point. Or if they're leveraging the pension option, does it make sense to leverage the pension maximization strategy or just stay within your pension plan? Maybe it might make sense to leverage a lump sum pension option and not use life insurance and just maybe create a combination of investments and annuities to produce income, to produce joint income, from that. So there's a multitude of different things if somebody does have access to that pension option. And then the cash value plans, this is really for every walk of life. This could be for an individual that ideally is about 10, 15, 20 years out from retirement, that they want to accrue their monies and receive some sort of tax-free benefit in retirement. When they're able to receive tax-free income in retirement, that's also going to reduce the amount of potential Social Security income that's taxed, known as provisional income. So cash value life insurance plans, when taken the correct way, does not increase the amount of provisional income. It's therefore does not increase the amount of potential Social Security taxation. So that's where it could work out very successfully in a retirement planning aspect. But you just have to be careful. At the end of the day, what are some solutions for this? It really depends on what your goals are. If you're not really sure what your goals are, well, then you probably need help to figure out what those goals are. If you do know what your goals are, but you don't know how to properly get there, you're afraid to get there, and you want some professional advice, well, then that's where you would sort out. You would obviously look up different publications. You could obviously leverage our company. You could call over to different advisory groups to try to help you out with this type of situation. At the end of the day, it's just looking at an account like a tool. So you want to use the right account like a tool for the correct tool. So like if you're trying to hammer in a nail, can you use the back of a screwdriver? And the answer is yes. But won't it be more effective? Won't it be less time consuming than using an actual hammer to do so? And that's the whole concept of financial products, of financial accounts. You just want to use the proper tools so that you're able to leverage the correct account to make sure to make your life 10 times easier. To make sure, when I'm saying 10 times easier, meaning you might not have to, if you thought, oh, I have to work until age 70, but you could mathematically complete your retirement success by the time you're age 62, well, why the hell would you want to work for an extra 8 years if you hate your job? So that's, some people love their job and they still want to work part-time, and that's fine, more power to them. But it's just, at the end of the day, it's not magic, it's just math. How exactly can you mathematically put yourself in the best situation, but make sure that you're not, you don't step in all the little, crap piles along the way, all the little turd piles of mistakes along the way, because with retirement, you only have one chance to get things done correctly. If you mess up on it, that's going to be the difference of you having to go back to work when you're late 60s, 70s, sometimes in your 80s, because you burnt through all your cash. So by making sure you're leveraging this properly, making sure you're covering your bases, that's where you could have that, obviously that proper retirement success. One of the things we do, what I mentioned, which just talks about a sliver of what we do. We have a trademark process known as the Retirement Diet Plan, where we help out individuals. We basically take the 4 main areas of retirement planning and we create a plan for an individual. We don't just say, okay, here's a portfolio, set it and forget it and call it a day. We want to make sure that you are covered from all different angles so that you have confidence in your plan. You know that you're not going to have stress throughout retirement, and it's going to get you from point A, where you are right now, to point B, and then from point B until date of death successfully, making sure that you have confidence all along the way. So if you found value in this video, feel free to reach out to us. Feel free to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. Thanks so much, guys.